The ESG investing strategies recently come under fire. Saving the globe and society sound good on paper, but these are some awfully lofty goals. So does ESG investing really deliver on what it says? And how does the performance of ESG strategies compare against non or anti-ESG strategies? Well, today's audience requested ETF battle gets to the bottom of this question. We've got a triple header between two pro-ESG ETFs from Blackrock and Vanguard going up against an anti-ESG ETF from Constrained Capital. These are the types of ETF battles that I enjoy. This is going to be good. Stick around. This is ETF Battles. I'm Ron DeLegge, and a warm welcome to all. This is a brand new season for ETF Battles, and if you're counting, this is season 4, folks. It's pretty awesome. Time has flown, but we're glad to have you along with us for the ride. Keep your excellent ETF battle requests coming. Send us your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. If we choose your battle, you win your choice of an ETF Battle shirt or a coffee mug. Also, a quick and big reminder, be sure to register for our upcoming retirement planning webinar in January and February. If you are nearing retirement or already retired, you should be there. We're going to show you how to avoid distribution pitfalls. We're going to show you how to reduce taxes, maximize your Social Security income, and protect your retirement nest egg. These will be just some of the topics covered. Attendance is free to all of our audience members, but space is limited. So be sure to visit the description section below. We've got registration links to claim your spot. The ESG and anti-ESG investing strategies are polar opposites. Now, ESG is supposed to back companies that are good for the planet and good for society and the social welfare of all, whereas the anti-ESG strategy basically invests without these sort of restrictions. Now, more recently, ESG investing has come under fire for its inconsistencies, its questionable additions, and exclusions of portfolio companies. We've got a lot to cover on today's program. We're going to get into this. We also have to be very careful on today's program because the sensitivity police are watching. And if we don't be careful, they're going to throw us in social media jail. That said, I personally invite he or she among us who is sin-free to cast the first stone. Judging today's contest is an illustrious duo. We've got David Dierking at TheStreet.com and Tom Psarofagis at Bloomberg. It's great to see both of you, judges. Welcome back.
Hey, guys. Nice to see you again.
Hey, Ron. Good to see you.
So our 4 battle categories are cost, exposure strategy, performance, and then our mystery category. The mystery, of course, is where you, our judges, can pick any factor or multiple factors that you feel are key to today's outcome. Our judges can also opt for wild cards or split decisions. It's up to them. I've got the scorekeeping chores. Keep in mind that none of the outcomes on this program are ever predetermined or known in advance by myself or our judges. So let's kick things off with David. David, the first category is cost. Please get us started.
Yeah, if you have a Vanguard and iShares fund in the group, they're going to come with really low costs, and these two funds aren't an exception. Vanguard comes in at 9 basis points. ESGU comes in at 15 basis points. So I think within those two, the Vanguard fund comes out ahead. Constrained Capital and the Orphan ETF, that comes in at 75 basis points, so it's really not even a consideration. It's a tiny $3 million fund, so trading costs are high too. I'm going to give the win to Vanguard based on the lowest expense ratio.
Thank you, David. You're up next, Tom. Give us your analysis on cost, please.
Pretty clean cut. Vanguard's 9 basis points. The iShares one's 15. So, I don't have a lot to add there. So some stuff I will add, AUM-wise, they're both a good size, both the Vanguard and the iShares one, a little over $5 billion for Vanguard, $19 billion for the iShares one. I will say it could be a little misleading. A lot of that is just iShares sort of own models that they had put their own clients in. So that number might be a little bit on the higher side, but both, have a good amount of assets, decent amount of trading, but at least from a straight line expense ratio, it's clearly Vanguard's the winner here.
Thank you, Tom. that takes us next to exposure strategy. And Tom, you're still up, so give us your analysis.
Yeah, and this is where it starts to get really interesting with ESG. Now they're both, U.S. The Vanguard one might stretch a little bit down the market cap spectrum, but for the most part, the pretty large cap focus. Now they're relying on ESG ratings, so as you can imagine, they sort of all gravitate towards a lot of the same names, meaning, excluding quote unquote the bad actors, tobacco companies, weapons, coal, traditional oil companies. A lot of those are excluded, from that. So, and they tend to be overweight tech. So they're both pretty similar in that aspect. And so the interesting thing is just some clever language in the name of the iShares product. It's called ESG aware, right? So it's they're made to mimic the broader index, so very close to the S&P, maintaining those very similar weights, but having some sort of ESG aware screen. So I think that's really important when investors are looking at it, that it's not sort of like a pure ESG strategy, just like an aware. So it's part of the whole process. So it's a little bit watered down. You're essentially just getting, a little bit of a S&P X some certain areas. So other than that, they're both really close. I think I would probably give it to the iShares product, only that they're using MSCI. I think they're sort of the leader there in ESG scoring and some of the data there. And the fact that they're relying on that index, I think will give them a slight advantage. So it's really close, but I'll give this one to the iShares product ESGU.
David, you're up next. Give us your analysis on exposure strategy. Which of these three ETFs wins?
Yeah, when you're looking at ESG ETFs, you really have to kind of dig down into to see what they're excluding and what they're including, because there's really no one universal definition of what qualifies as ESG and what doesn't. So it really comes down to the issuer. Tom highlighted a lot of the differences between ESGU and ESGV. I'll just point out that Vanguard is a little more exclusionary than iShares is. ESGU basically screens out weapons, oil, coal, tobacco, those kind of names. Vanguard also screens out alcohol, cannabis, gambling, and it screens for things like human rights abuses too. So I guess it depends between those two funds how really exclusionary you want to be. Vanguard's a little more broad sweeping in what it screens out. iShares is a little less so. Orphan just kind of stands out there on its own. It's pretty much the opposite of those funds. It's interesting looking at the sector allocation of Orphan. It's pretty much energy, industrials, staples, and utilities at about 25% each. So it's actually very narrow in what it includes. Tom mentioned that there's a lot of tech in the ESG funds. Orphan has pretty much nothing in there. So it's really two very different portfolios. I think the ESG or non-ESG decision really comes down to the individual investor. So, I think you kind of have to set Orphan aside for this one because it's so different. But between ESGU and ESGV, I'm going to call it a split decision. It really just depends on how exclusionary you want to be on those ESG screens.
The next category is performance. And David, you're up. Give us your analysis.
Yeah, between ESGU and ESGV, there's not a whole lot of difference in performance. If you go back to late 2018 when they were both around, I think it's like 40% to 36 or 37%. So, obviously they're using pretty much substantially similar targeting strategies. So it's not surprising the returns are nearly the same. Orphan has only been around since the middle of 2022, so we really don't have a good sense as to how it performs long term. Since it's been around, though, it's been up about 7%, whereas the ESG funds are down about 5 or 6%. So there has been a pretty substantial performance difference. And again, that goes back to the sector allocation of Orphan, the utilities, the staples, the energy. Those are all the sectors that have done really well over the last year. So it's not surprising to see this strategy do well. But over the long term, we'll have to see how it plays out. I'll throw out the wild card of the Vice ETF. It's sort of the natural comparison to Orphan here. It uses a pretty similar anti-ESG strategy, but it's been around for about 5 years or so. Over the 5 years, it's trailed the ESG funds quite a bit, but again, the last 5 years have pretty much been dominated by mega cap growth and tech. So the types of companies that it invests in really haven't been in favor. So again, not surprising to see it underperform. But as far as performance, I'm going to call it a split decision again between ESGU and ESGV, just because they're pretty much similar.
Tom, you're up next. How do you see it in terms of performance? Do you agree with David's analysis?
Yeah, I agree with a lot of it. Let's put Orphan aside first, and we'll just talk about the two ESG ones. Over time, again, they pretty much look like the S&P, a couple basis point difference. So just be aware that, for the ESGU, you're paying 15 bips when you could be paying, 3 bips for VOO or whatnot. So I think just investors should just keep aware how different these are, and the performance is essentially the same. But Orphan, yeah, it's really owned the stuff that's been doing fantastic. The oil companies, aerospace and defense is like hitting new all-time highs. So really the stuff that has been hated is the stuff that's been doing really, really well. So the performance has been quite good for Orphan. And one thing I noticed just feeds into like how confusing all of this is. There's an 8% overlap between Orphan and ESGU, right? It's like between the Orphan names and these. So there's some of these are actually in the ESGU ETF, and this is why it can get so convoluted very quickly about ESG. But I give credit to Constrained Capital. I think they're trying something new, something very different, something very anti, which is sort of a big trend in the industry. There's anti-Cathie Wood, anti-ESG, anti all of this. So kudos for it. I'll give the performance one to them because it's so different. And really, I just think if you're going to buy ESGU and ESGV, you're really just getting the S&P. This thing is truly different. So, in again, very short track record, but the performance has been quite well. So I'll give this one up to Orphan.
Well, our judges are bringing it today, and I'm enjoying this awesome analysis. I hope you are too. That's going to take us next to the mystery battle category. So how will our judges come out in terms of their mystery categories? And will this be the deciding factor in today's ETF showdown? So, Tom, what is your mystery battle category? What is it, and which of these ETFs wins it?
Sure. So the one, even though I just promoted Orphan, this is going to work against it. And the thing that really worries me is closure risk. And while I give them credit for what they did, it's a small ETF. It's only got a couple million. I don't see this thing really being widely adopted. I think it's more of like a statement ETF than people actually allocating to it. So I wouldn't be surprised, unfortunately, if this closed. So I would hate to recommend something that eventually might liquidate. So in terms of the least closure risk, I think both the iShares and the Vanguard product are pretty safe. Probably more so the iShares because they're pretty dedicated to this ESG premise. But unfortunately, I think closure risk is a real risk for Orphan. So it's just something to be aware of. And if someone's since it's just energy or aerospace and defense names, there's XLE, there's ITA, there's a lot of other ETFs that exist that you can maybe play a sort of Orphan-like theme through one of these big sector ETFs. So just be a lookout for some of these small ETFs that might potentially liquidate.
Thank you, Tom, for those points. David, you're up next. What is your mystery battle category, and which of these ETFs stands out?
Yeah, my mystery category is going to be yield. And the reason I bring this up is because if you sort of set the social stigma of anti-ESG aside, this is actually a fund that really includes a lot of good cyclical and defensive names. It tends to include companies that are durable and mature. They generate a lot of cash. So if you take the anti-ESG label off it, this is, actually a legitimate investment strategy that I think can work in a portfolio. And because it tilts towards a lot of those defensive and cyclical names, it does actually provide a higher yield than the S&P 500 or, by extension, these ESG funds. Over the last 12 months, Orphan has actually paid out twice as much in dividend income as the ESG funds. The gap isn't quite as high today. I think it yields about 50 basis points more than ESG, but I think just because of the nature of what it's targeting, a lot of these cigarette makers and alcohol producers and things like that. These are going to be companies that just generate a lot of cash, and in a lot of cases that translates into bigger dividend yield. So if you are a yield seeker or looking to generate income in your portfolio, I think Orphan, despite its issues, like Tom said, being such a tiny fund, is a legitimate strategy. So I expect it will pay a higher yield going forward as it has in the past. So if you're judging purely on dividend yield, I think Orphan is the win here.
Well, we're going to give our judges a final opportunity to weigh in with their overall battle winner. How will it go down? David, give us your overall winner.
This one's really tough because I don't think this is so much a battle between funds as it's just a battle between two different strategies, ESG and non-ESG. So, and again, it really comes down to investor preference, I think. If you're choosing between ESG funds, I'd probably give it a split decision between ESGU and ESGV. There's some small differences there as far as what it includes and what it doesn't, but they're both pretty cheap. They're both pretty big and liquid. Their performance is similar. Their yields are the same. There's just not a whole lot of difference to make one a clear-cut winner over the other. If you're strictly against ESG, then I think Orphan does a good job of that. If you, again, compare it to the Vice ETF, they're substantially similar, so I'm not sure there's much of an advantage with either one. Vice actually charges a 99 basis point expense ratio, so it's actually more expensive. But like Tom mentioned on closure risk, Vice is it's only got like 8 million in assets over 5 years. So I think he's right on. I don't think there's a really good chance that this is going to be around for the long term. So as far as choosing, I think Orphan works fine if you're really set on, really targeting those Vice names. I'm going to stick with split decision between ESGU and ESGV just because these funds are a little bigger, more well-established, and I imagine people are going to be targeting ESG strategies as opposed to specifically anti-ESG strategies in the future.
Tom, your final chance to weigh in with your overall winner. Give it to us.
Yeah, David makes all great comments. I think ESG is going to be under the microscope this year. You've already seen Vanguard's pulling out from I forget, there was some big carbon committee they're pulling out of. I think you'll see names start to drop. ETFs start to drop the ESG name from it. The SEC is looking into it. So I think it's going to be a real hot button item. I got to give it up for Orphan. I think it's something that's truly different. And I just I just feel like you're paying 15 bips for the S&P 500, right? I want to give kudos to the firms that are doing something very, very different. Despite it being a little bit more expensive, that's fine. I like what it represents for the industry. I like the strategy too. I think some of the stuff that's been unloved for so long could come back. But overall, I think all great points that David made, but I think I'm going to give it up for the Orphan ETF.
Well, our judges have weighed in, and according to my battle scorecard, this is a split decision. We've got split winners. We've got ESGU and ESGV, which got David's vote, and then ORFN, the underdog, gaining steam in the end and coming out with a victory, that ETF gaining Tom's favor. And of course, he liked the fact that it's radically different than anything else that we've discussed on today's program. It's radically different, not just from obviously ESG strategies. It's an anti-ESG strategy, but also the S&P 500, which, as Tom mentioned, the ESG, the pro-ESG ETFs mentioned in this contest perform very similarly. At least the risk pattern historically has mimicked very closely the S&P 500. So why even bother? And that was a point that was well received and well taken by me as a scorekeeper. Now, as far as David's points, he mentioned that listen, the ESG movement obviously is coming under scrutiny, but nevertheless, these particular ETFs from Blackrock and Vanguard are the biggest of their kind. And so, if you're looking to be a pro-ESG investor, then this, I guess, would be a starting point. And of course, the other thing I want to mention that David mentioned that I think is important too is yield. That was his mystery battle category. He voted for ORFN for that one. So if you're looking for more yield, obviously ORFN would be the choice and the one to look out for just because of its portfolio composition. And really great job by our judges. And I don't think we offended the sensitivity police too much on today's program. I'm sure I'll be getting the hate mail though, but nevertheless, I can take it. So again, thank you, David and Tom, for your excellent analysis and breaking down today's ESG versus anti-ESG strategies. Well done.
Thanks a lot, guys.
Thanks, Ron. Good luck in the comment section.
Thank you. I'm going to need it. Be sure to visit the description section below. We've got research links to our judges. Get in touch. Also, while you're there, check out the link to our program sponsor, Direction Investments. We've also got a ton of viewer resources along with registration links for our upcoming retirement webinar, which is free to all. So check that out. I'm Ron DeLegge. Thank you so much for watching ETF Battles. We'll see you next time.